Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Tony Zhang, chief strategist at OptionsPlay, for a review of U.S. markets and option strategies to trade the trends. Tony, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much for having me back.
All right, and Tony, the obvious question is, how is inflation data influencing market valuation? So let's start with what you are seeing in the tech space, Nasdaq 100 Volatility Index, and the 10-year, because that's certainly where the relationship is.
Exactly. So the markets had a bit of a, I would say, inverse directional move last week to what many market participants were expecting, especially after the Fed's announcement that they were likely going to raise rates a little earlier than expected and potentially talking about tapering by September. The fact that rates have declined since then, the 10-year yield, has propelled equities to new all-time highs. So, looking at the equity markets right now, one of the things that does concern me as these the Nasdaq, the S&P, and even the Dow Jones are starting to push to new all-time highs. We're seeing signs of exhaustion here, meaning as these equity indices push to new higher highs on price, we're not seeing those same momentum indicators confirming those new higher highs. And we're also seeing advanced decline lines failing at these new highs. This is showing us quite a bit of exhaustion here on these equity indices that are continuing to move higher. So this is some of the warning signals that I do want to make investors aware of. And in addition to that, when we look at VOLQ, which is the Nasdaq 100 Volatility Index, it is near 1-year lows. It is basically at those 1-year lows. So what we're seeing is that volatility is fairly complacent. Equity investors are not expecting a lot of future volatility. And sometimes when you look at those two in conjunction with each other, those are some of the opportunities for what could be some explosive moves if we do see some further downside. And I think the 10-year yield is really the one thing that could spark some risk here. We've had this inverse reaction to the Fed's announcement, and we also have some inflation data that has not quite settled the debate yet, whether inflation is more transitory or permanent. So the question is, if we see inflationary data to be a little bit more permanent than the market might be pricing in right now, that could cause another knee-jerk reaction here to rates, specifically higher, and that could, be the catalyst that could drive equity valuations lower. The one caveat I will say is that this could go on for quite some time. It could go on for weeks, perhaps even months, before you do see that kind of repricing, if you will, if there is some more permanent inflation that we're seeing.
So Tony, let's take a look at the sector rotation model, because of course we're seeing Nasdaq hit all-time highs this afternoon, June 23rd, a little bit of a pullback from the value trade, if you will.
That's exactly right. And when we look at the sector rotation model, one of the things that concerns me a little bit is the fact that there's not a lot of rotation going on here right now. We see technology, discretionary, and we do actually see healthcare coming in a bit of a stealth rally here, but you really just have those three sectors moving towards the leading category, while the other 7 or 8 are really, lagging behind. And that's showing narrowing market breadth. And that's what I was showing you. That's what I was talking before about the advanced decline line, and the number of stocks that are still advancing these days are actually declining. So when you see a lack of a sector rotation, a declining market breadth, those are concerns as equity markets push the new all-time highs. But as I said, this can continue to go on many times for weeks, sometimes months. So even though we are a little bit hesitant, if you will, to chase equities at these all-time highs, if you're looking for long opportunities, it's important to understand which sectors are strongest, which sectors are weakest, as you position for long shorts within the equity markets using that type of data.
And Tony, before we get into our trades here, let's take a closer look at inflation data and some of the stats that you've provided.
Yeah, so it's really, on two fronts that the Fed is looking at inflation. One is wages, the other one are consumer pricing. And right now, like I said, the debate is still open. But I will say that on the consumer prices, both paid and received from the Richmond Fed manufacturing data that just came out earlier today, we are starting to see the pricing power come down a little bit. Now, this is just 1 week's worth of data, not quite enough, I think, to make a trend here. here, but we are starting to see some of that ease a little in terms of raw material pricing. We've seen copper, we've seen lumber come down in terms of pricing. But on the other side, the wages side, we're not seeing any lift off there just yet. We're still seeing wages actually continuing to rise, especially in the manufacturing and services side. This is really where I think it's a little bit more concerning as we talk about more permanent inflation. It's really some of these wages that could continue to drive consumer prices even higher. So the debate is still out there. And if you look on both sides, one side is looking like it's coming down a little bit. The other side still, I think the jury's still out.
Tony, so we have a couple of trades for everyone today, one for the bulls, one for the bears. Let's start with the bulls trade in Thermo Fisher.
Yeah, so this is really where, for me, I think playing a little bit more on the value side, playing a little bit more defensive is where I'd prefer to be. Healthcare is not the sexiest sector, if you will, like technology is. So there is some strength we're seeing out of the healthcare space, and Thermo Fisher really represents a fairly diversified play within life sciences and healthcare. Recently showing quite a bit of strength here, so I'm looking for some further upside here. But like I said, chasing equity markets near all-time highs is not something that I love to do, which is why I'm using options to try to protect my downside. I'm going out to August and I'm buying the 490, 530 call debit spread here. And I'm using a debit spread because implied volatility, as I was showing you before, using VOLQ is near all-time lows. So buying volatility right now is relatively cheap. So I can do so by protecting my downside here, reducing my total risk on the overall trade just to about 3% of the underlying stock's value. So if we do see a pullback here in equities, I'm protecting myself to the downside by using a call debit spread that actually risks one of the smallest amounts possible using an option strategy.
And Tony, our final trade of the day here, taking a play in the industrial weakness that we've seen with Honeywell.
Yeah, so industrials remain fairly weak. We've seen a bit of a rally here over the last couple of days, but I do think that there is potential for further downside here for industrials. So when we look at some of the names that are a little bit more weaker within this particular space, you look at Honeywell, which is predominantly exposed to commercial aerospace, which we have an uneasiness about over the next couple of years. Also commercial office space and automation in terms of manufacturing. Honeywell is really, I think, at risk here of potentially a further pullback. It recently broke below the 220 support level here. So I'm using a trade structure, again, similar to what I'm using for Thermo Fisher, a put debit spread for the bear side. I'm going out to September here and I'm buying the 220 195 put spread here, spending about $854 for a $216 stock. That also is roughly about 3% of the underlying stock's value that I'm risking. Very well, equity markets could continue moving higher and stocks like Honeywell will just simply participate in part of that. But if it doesn't and it starts to roll over here, I expect stocks like Honeywell will accelerate further to the downside than what equity markets are trading. So that's why I'm using a debit spread to try to take advantage of that by risking less to potentially try to make more if we do see that acceleration to the downside.
All right, Tony, where can traders in the US get in touch with you?
Yeah, so we have a full 30-day trial for TradeTalks viewers. If you want to take a look at everything that we have to offer in terms of research, in terms of the platform to help you analyze these types of option strategies, a free 30-day trial is available at trade.optionsplay.com/TradeTalks.
All right, Tony, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.